A common question amongst new investors is how to invest $1,000 in the stock market. And the answer is clearly investing in penny stocks, because that's the only way you're going to turn that $1,000 into $1 million or turn that $1,000 into zero. In this video, we're going to be talking about the mindset to maximize the education, as well as how I would set myself up as I grew my portfolio. Once I have 100,000, 200,000, I wouldn't be shooting myself in the foot with bad habits. First off, this video assumes you know what a stock is or what an index ETF is. And if you don't, pause the video, go watch another video about those things and understand just the basic fundamentals of what I'm talking about. As I alluded to in the intro about penny stocks, the mindset is extremely important to establish when you're younger. When I had $1,000 to invest, my idea was, I'll just 10x this, turn it to 10,000, turn that 10,000 into 100,000, and I'll do it within a year. Easy peasy. But what you realize is that those types of gains are absolutely insane. And in order to achieve that, you have to be extremely risky, and you also have to be extremely lucky. If you get those types of gains within a year, we're talking more about gambling versus investing. You have to manage those expectations, because if you look at something like the S&P 500, which mimics the overall stock market, it's a bunch of different companies across sectors, and look at the historical returns for that, you get 8 to 10% per year. One year it may be up 30%, the next year it may be down 10, but over the long term, it's 8 to 10%. Now, you may be saying, shut up, boomer, you gotta risk it to get the biscuit, right? 400%, maybe you did make a lot of money on a volatile stock like Sundial Growers. Now, the danger is if you keep on allocating a lot of your funds to these types of plays, and instead of going up 100, 200%, it falls 90% over a year because maybe it's not the strongest business from a fundamental standpoint. It does come down to a bit of risk management, which you learn usually after getting burned. I think the most important thing when investing $1,000 is maximizing your education. So the allocation I would probably use would be 80% in index funds to track the overall market and get your feet wet with investing without any knowledge. Something like the S&P 500, and you get exposure to JP Morgan, Google, Amazon. You get slices of all these companies, and you have to know nothing.
You know nothing, Jon Snow.
About business, stocks, anything like that. You just follow what the stock market generates. With the rest of the 20%, this is kind of your fun money or your learning money, because this is where you're gonna buy individual stocks. So it may not be a lot of money on a $1,000 account to buy $200 worth of shares in Apple or Tesla, whatever company that you like. But just by investing in these companies, you'll start to pay attention to the company, whether that's quarterly reports that come out from their earnings, or maybe good news comes out and the stock goes down. Each time an event happens and the stock moves, you understand something new. The stock market is down 2% and your stock is flat. Why? Is it because it has a low beta? Is it because good news came out to counteract that? Is it because the news of the market didn't affect that industry? These are all things that you learn as you invest and you're paying attention to the market. Okay, but why only 20%? Why aren't we YOLOing our entire account into Tesla? Well, one, if you completely suck at investing and the 20% really underperforms, you still have the S&P 500 investment to carry you. You understand, hey, maybe I'm not cut out for this whole investing thing. Maybe I'll just go the passive route. If with that 20%, you really enjoy researching stocks and also improve yourself as an investor, well, maybe you want to become more active. And so as you grow the portfolio to 10,000, 20,000 by saving and investing money from the personal finance side of things, continually investing into this account, well, now you have the confidence to actually be more active. The reason I say not to do 100% index investing is because you'll always wonder, what if I was more active? If you are active with 20% of your portfolio, well, now you can compare those results of those companies that you invested in versus the index funds. So you can see, hey, am I generating alpha, which is basically risk-adjusted returns that are higher than the general stock market, the S&P 500. And if you are, and you're enjoying it, then you can be more active. If you hate researching stocks, trying to generate alpha, getting those average returns is completely fine, and you just focus on throwing money in the investment account instead of trying to maximize returns. Now that we've talked about the mindset and the allocation and the reasoning behind those two, let's talk about where you're actually investing your money in. Well, first off, you have to pick a brokerage account. Most of them nowadays have free trading, so something like Webull or Fidelity. And you can also pick between a normal brokerage account or something that is tax advantaged like a Roth IRA or a traditional IRA. And these types of tax advantage accounts are great if you're investing for retirement. So if you need the money earlier than retirement, maybe you want to just get your feet wet in a normal brokerage account, you can open one of those. But if you're investing for retirement, it always makes sense just to use the tax advantage ones because you'll save money from a tax perspective, which can be huge over a longer period of time. With a $1,000 account, I actually prefer it to lose money to begin with. Make mistakes, invest in those risky companies without fully understanding the valuation, kind of chase those hot stocks, things like that. And if you lose money on these bad habits, well, hopefully you learn from them. And on the flip side of that, if you made money from Tesla or really any company you invested in, just understanding why or asking questions why will help you become a better investor. At the end of the day, $1,000 isn't life-changing. The whole point of $1,000 is to learn. That way, when you're investing more money, you are a smarter investor, more emotionally intelligent, you can deal with losses and not panic, you can avoid greed, all that good stuff. Investing $1,000 is extremely important, not because you can turn that 1,000 into 10,000, it's because you can train your mindset to be a better long-term investor. If you did enjoy this video, make sure to give it a like, as well as consider subscribing to Main Street Wolf, where we talk investing, anything to do with money. Thanks guys for watching, and have a great day.